Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.
All right, welcome back to the Winner's Playbook. Another episode here, joined with my regular co-host, Billy Norman. Billy, how's the week going, mate?
Yeah, not bad. Thanks, Josh. Looking forward to the weekend, getting down to Sorrento for a night.
Good weather.
For a long lunch. It's a little child-free with a few mates.
Jeez, that's a bonus.
A couple of other couples, should I say.
Yeah.
So, yeah, very excited about that.
How'd you get rid of the kids? Where are they?
Oh, look, I have to organise these things far in advance, but I've got my mum. They're going to mum's house, so.
Nice.
She's looking forward to it.
That sounds amazing. It's good weather as well. It's good. I think, what is it, 32 today and 36 tomorrow, I think?
Yeah.
Awesome.
Yeah,
are you going to
nice.
be at beach or?
They do have a pool. It's like a friend's parents, the old sort of holiday house that's been there. I think they put a pool in a couple of years ago. So
Nice.
that'll be nice. How about yourself? I heard you've had some issues with your chickens out in the backyard there at your place.
Yeah, I was just saying before we got on here, I jumped out of a client meeting and I go and let my chickens out early in the morning. So I just went just to have a look at them, and I saw one of them and she was a little bit distressed, and I was like, "Hang on, where's your mate? Where's your chicken friend?" And I could hear some chirping on the other side of the fence, and then I sort of ducked around and could see the chicken was actually stuck between the tennis court and the fence. And on my neighbour's side, and to make the matter worse, they've got two big Rottweilers. But luckily, they actually have them in a cage during the day, because if not, I could have had a disaster before. But I managed to actually somehow coerce the chicken to coming back to its house, and stuck my hand through the fence and was clicking at it, and it actually followed my voice and jumped through. So I don't know if that's just the chickens trusting me, or he was scared for his life. Probably
Just the chicken whisperer there.
Yeah, maybe. I don't know. But yeah, the chickens are good fun when they're producing eggs. They haven't been producing any eggs as of late because of some of the heat. So it's hasn't been a great investment on my part at this point in time. I'm pretty negative in the for dollars wise, as opposed to how many eggs they've produced. So it might not have been a good idea getting them. But anyway, we won't talk about my chickens any longer, because we're going to be talking about the hidden costs of home ownership, which is a very interesting one, because obviously Aussies absolutely love property, bricks and mortar, safe as houses, as everyone would say. But the dynamics obviously changing a lot with the older generations and new generation in terms of the cost to get into housing. It's always been expensive in relative terms. And I was actually chatting with some clients yesterday who had purchased a CGT free asset before 1985. They'd actually bought a property. Actually, sorry, that was land, but for $17,000. They bought half an acre of land in Victoria for $17,000 pre-1985, and they're going to be able to sell that tax free. But of course, I don't know if there's anywhere in Australia you can buy a half acre now for $17,000. I'm not sure about that, but the cost of buying homes obviously gone up, and there's a lot of costs in there that people aren't so aware of. So that's really what we're going to be deep diving into today. And what if we start with Billy sort of talking about some of those, some of those financial surprises or costs that new homeowners buying their first home you need to be aware of before you jump into the game?
Yeah, well, I think the common issue is that people will just focus on the home loan. Right, they'll just run the numbers on the home loan. What are the repayments?
Yeah.
They might compare that with what they're paying now in rent, and then often they won't go too far beyond that in terms of looking at the numbers. And so what they're missing, there's two things. One is the upfront costs. Right, you bought a new house. Oh, well, we can't take our crappy furniture from our rental into this nice new house we've just bought. We'll need to buy some furniture. Oh, the fridge is too old, or we need a bigger fridge. So you're buying appliances, furniture potentially. And so you're furnishing the place, right? And you've got removalists. You might have to clean your old place. So there's all these upfront costs which you need to budget in.
Yep.
Okay, now you're settled into the house. Now we've got the ongoing costs of home ownership. Now the fixed costs I don't think are too dramatic. Like you might be talking about council rates and some insurances. But I think it's the repairs and maintenance, which is the big one, and unpredictable at times as well.
Yeah.
What's your experience? Like you've owned properties for a few years now. What have you had some experiences there with the repairs and maintenance, or the unpredictable costs that can come up?
Yeah, I like buying our first home. It's a good one you mentioned about the furnishing. I didn't actually have that noted down as a part I was going to chat on, but I think it's a really good one to note because like when we bought our first home, we actually had a full deposit ready to go, but then we put in less deposit and we were in a fortunate enough situation to use a guarantor arrangement to buy our first home with the help of of the in-laws. So we had the money ready to go, but yeah, we hadn't really thought through, like you were saying, you kind of look at the loan repayments, you're like, yeah, we're good to go. But hadn't really thought through, fridge, couch, all of the furnishing situation because we were living at home at that point in time. I think we were 20. And so we had nothing besides my bedroom at that point in time. So I think we ended up spending maybe it might have been 30 to 40 grand possibly on everything once it was all said and done. So we made sure we kept some funds aside because you can definitely get caught out from that perspective. And there might be some parts of the house that aren't fully finished or the way that you like them as well. Like we actually had to do a lot of landscaping on the home that we bought. It was pretty bare bones. There actually wasn't a fence line to it. So it was quite a unique property in that it was 1,500 squares. I don't actually have any neighbors to it, but there was no front fence line. There was a rear and both sides, but there was no front fence line. So it was actually a lot of different costs that we hadn't really thought of. We bought the property at an auction, which was quite scary buying our first home, nevertheless, because that was a learning curve in itself. But yeah, we probably did the thing you shouldn't do. We hadn't really thought about some of those costs, but then we got into it. But like a lot of things in life, you just adjust and you figure it out once you're in. You don't really have a choice. But I think the furnishing one is a big one. But talking to the repairs and maintenance.
Yeah.
On the properties I've owned, just thinking through, I haven't had anything major, fortunately. I haven't had anything major actually really pop up. There's been a lot of add-ons, like adding on a shed at that property that we purchased and like a lot of little things like, ceiling fans in rooms and things like that. But I haven't had an issue ever with anything major. All of the homes I've owned have been pretty new. So I haven't had too much of that to worry about, but I can probably talk from clients as well that I see. I've had some clients that have been really caught out with some problems like termite damage and water leaks and things like that have actually costed a fair amount of money. Of course, that's why you have insurance for, of course, as well. But there's some of the things that are a little bit scary and keep you up at night if they are to occur. But that, I suppose, talks to, Billy, why you get your build and pest inspection done before you buy any home to try and look for any of those hidden nasties. I have nearly bought some properties before, and one of them we nearly went through, but it fell down because there was water found in one of the bathrooms. This was in South Australia, and the tenant, sorry, not the tenant, the owner just got weird about the whole thing, wouldn't let us do any other checks, and then we pulled out on the contract at that point in time. So there's a lot of things you can definitely do to stack the odds in your favor, but there's always the unknown that could happen at any point in time. But I guess that's why you have your insurances there in place to hopefully protect you against it, or if not, getting into a point of maybe having like an emergency fund and some cash flow as well. But the bills are the bills, like you said, that's it. Maintenance is, that's probably the trap, I think, with family homes. I don't know, you've done a bit of renovations on your place, haven't you, Billy? Like, I think that's the part that you got to watch of the spending on, always doing the home up, because it is an emotional attachment, that home you live in. It's a bit different than buying an investment property where there's not really any emotion attached to it. But when you get in your home, like, you could just keep throwing money at the thing, doing renovations forever into the future. So what about, you've done a bit of renovations at the back of your place, haven't you, Billy?
Yeah, I mean, we haven't wanted to spend a whole lot of money on our house, and we didn't for the first few years. But then just naturally things started happening, like hot water system stopped working, had to go get a whole new one. The heating and cooling system's now 20 years old, so we had to go buy some split systems. And then we did have our first major repair issue, and we had underneath the shower, water was leaking from the top floor down into the roof of the bottom floor. And I learned the hard way, insurance doesn't cover that.
Tough.
So they say, well, that's a maintenance issue you need to be aware of. Oof. But it's happening under the floor of the shower, so there's no way to even know that you need to maintain it. So that, I guess that's a classic example of something happening where you just can't even really predict it or prevent it from happening.
Yeah.
So how do you prepare for that? I mean, it all comes back to having cash reserves, right?
Yeah.
And as you said, when you first bought your place, you don't want to use all of your savings for that deposit, ideally. You want to borrow more than you need so that you've got a big cash reserve that just sits there.
Yep.
And when if you're living in a share house, when you're younger, you're living in a share house, you don't need a big emergency fund. But if you buy a house and you take out a big home loan, then you need a much bigger emergency fund.
Yep.
Because that stuff could just come out of nowhere.
Yeah, I agree. So, but like budgeting for those hidden costs, which really aren't hidden. Like maintenance is not hidden, insurance and property taxes is different. If it's a home you're living in you don't have property taxes, so to speak. But then you have your rates, your body corporate, etc. So none of those things are really hidden. But you hit on the point of having an emergency fund or a buffer in place. But we obviously do a lot of work around cash flow structuring for clients as well, and that's probably the most important part I thought about, was just having an actual cash flow system in place, like not living off your credit card, which a lot of people actually do. I see so many people living off a credit card, and I used to do that as well, with the thought of, I'm getting all these extra Qantas points, I pay all my money I pay everything on the credit card, and then I clear it last minute. I'm amazing, I've got all these Qantas points. But what really is happening there in reality, 9.9 times out of 10 in my opinion, you're actually spending more money on the credit card than you would have if you separated out your cash flow and you didn't use the credit card for daily expenditure. So I think there are some little things that you can sort of stack in your favor to then ensure you can withstand any of those expenses when they do come up, and of course actually allow for them in your cash flow structure. Like that's what we do with our clients. Like we make the estimate or use the actual figures on what rates are going to be, your insurance costs are going to be. So none of that's really a surprise. And then when those surprises do happen, or there's damage or whatever it may be, in your instance, that water leak, well, hopefully you're in a situation where you've got some funds aside so you can actually get out of that, and the damage doesn't get worse. But I had a thought, Billy, I was going to throw back to you on a hidden cost possibly that people don't know about, and I probably didn't truly understand when I bought my first property, was like body corporates and strata. And when you have a unit or a property that's a part of a body corporate or a strata, we were actually chatting about this I think a bit earlier in the week with one of my properties, and yeah, you don't really understand what that cost is, because you still pay your rates. So you still actually pay your rates to the council, and then you're paying your body corporate on that. And I've got a property which is weirdly a part of a body corporate, even though it's a freestanding home. It's just very odd it's a part of one. But my body corporate fees have gone up extravagantly since I've bought that property, and it's very frustrating on how that works. And I think you've had some clients who have then been caught out with damage being done in a sort of strata build, and then they raise, special levies. And do you want to maybe just briefly touch on that, Billy, and some of the, like those risks of having units and strata? Yeah. That can be something that is here if something goes wrong there.
Yeah. This was a horror story. Someone who reached out to me, and she bought into an apartment building. And not a huge building, like I think it had maybe 20 or 30 units in it. And then they found out the building was defective. And like whenever there was heavy rain, there was rain flowing in from the balconies into people's bedrooms. So they had to do major repairs on the outside of the building, and all the bathrooms are leaking and all sorts of stuff. Anyway, The costs were mounted, and it got to the point the building had to borrow $3 million to fix all these issues. And that $3 million, all the 20 owners all have to repay that debt over the next 15 years. And that then feeds out into their body corporate fees. So every apartment owner there was on the hook for like 15 grand a year in extra body corp costs. Yeah. And you can imagine what that did to the value of the unit. Like if you want to sell out, whoever buys in is on the hook for those costs. So I mean that's a rare nightmare situation, I guess. But yeah, there's some risks in the body corporate situation. Yeah.
Yeah, and buying a unit in general, and that's maybe talking to buying, units versus homes. Like it's not true that all units don't grow, but if you're asking me what I've experienced, most clients I see that buy units don't do well out of them comparative to if they'd bought a house. And in a lot of situations, they either don't grow, they go backwards worst case, or they grow at just a marginal rate. But compare that to buying an actual home, it's not even in comparison. And most clients then end up selling those properties. But yeah, buying a unit might make sense if you've just got a very limited borrowing capacity and you're never going to get yourself into the market. But you got to, like, the units can be good lifestyle decisions. So I would argue maybe you don't buy the unit, maybe you just rent the unit instead.
Well, also you don't buy off the plan, because it's a whole nother risk, right? The build risk.
Exactly.
Like what's the build quality going to be? You don't find out until it's done. So
yeah, that's getting
better off buying something that's already there. You can get a proper inspection done. Yeah.
Yeah, well, that's getting murky and scary. And there's obviously a lot of, property spruikers out there that sell clients on this stuff. Unfortunately, that property industry is a really interesting one in terms of some of the lack of regulation around, what people are doing out there. And there's a few cowboys out there, and unfortunately, I have seen clients get sucked into certain situations which are not great. But that's what it all comes down to, that education piece. But what if we talk to the fact of buying versus renting, Billy? What do you tell clients? Should I buy? Should I rent? And everyone always hears, if I'm renting, is that dead money? What do you say to people?
This is an interesting one, and I think the dynamic has changed over the last 5 years in particular, because the cost of owning a house is so much higher now. Like rates are higher, and insurance costs have gone up, build costs have gone up, everything. So, and even though rents have gone up, that pales in comparison, because when you rent, all you're on the hook for is that weekly or monthly rental and nothing else. Exactly. And you can move house whenever you want. So in my view, it is absolutely worth looking at a rent vesting strategy for a lot of people. Like, if you want flexibility, if you can't afford to buy in the area that you ideally want to live, it's worth looking at. And there are tax benefits in that strategy, significant tax benefits.
Yeah.
Yeah. Is that what you've seen as well with some of your clients?
I've look, there's no right or wrong. Like, I do have this discussion a lot with clients, and there's pros and cons of, buying and rent or rent vesting. And I guess there's other ways to look at the rent vesting situation. And so rent vesting, you want to live in a certain location, you can't really afford to buy in there. It might be a multi-million-dollar suburb, whatever it may be. But then you look at then renting that property. And I was doing this in a suburb just over a year ago. I was rent vesting for a couple of years. I absolutely loved it. And it worked really well for our situation for a period of time there, because I did the numbers. I think I did a video at one point in time on my social media, and the numbers of renting that property versus me owning it, putting down a standard deposit, like, I think it was about half the cost for me to rent that property as opposed to own it. Now, of course, you can argue and go, well, you're losing that money. You don't then have an asset. But that decision for me to go rent vesting was actually to move closer into our office, because I was living previously right out in the southeast of Melbourne, and I was probably be burning 2 to 2.5 hours a day driving. And that, I thought, was, well, that's me losing money because of my time, and I can't work and do certain things. So I actually made the move to rent vest, not just purely from buying more property, but to actually get closer into where I was working. That was going to save me time and save me money, and actually put me more ahead from a financial position. So rent vesting, I think there is more to consider about it, but that's, again, you're renting where ideally you want to live. You get that as a rental, and then you are buying an investment property or properties outside of that. And that's exactly what I started doing. And that's the typical rent vest strategy. You get tax benefits associated with it, like you were saying, because those properties are a good debt, negatively geared, everyone's best friend. So you get a tax break for the loss that you're going to have on those properties. So that is a positive, as opposed to if you have a home you're living in, you're just paying all of the outgoings there. There's no tax break on anything whatsoever. But it is worthy of noting that you can still sell that property tax-free at any point in time. So that's where there is no simple way to say what's the right solution, because it's going to be very variable based upon circumstance, because it's pretty powerful retaining that main residence exemption, where you can sell that property tax-free at any stage in the future. If you buy for $1 million and it goes to $2 million, if that's your family home, you can sell it tax-free. Whereas if that was an investment property and you want to sell it, that's a huge capital gain that you're going to be up for. And that's where you can even go into the fact of, well, if you're going to buy, is maybe think a little bit more around, is that going to be our forever home? Like, do we want to live in that home forever? Or is this maybe just a step into the market and then it's going to become an investment property then anyway? And that's what I did. First home, got into the market, stayed for a few years, then left, still have that property as an investment property. But then there's a neat thing called that 6-year rule as well. So I don't want to get too complicated with some of this, but that 6-year rule, which allows you I could still sell that home at this point in time right now, even though I'm now living in another principal place of residence. I could use that 6-year rule for another couple of years. And if I want to sell that property and pay no capital gains tax on it, because it was our principal place of residence from the beginning. So I guess if you're trying to scale or build a property portfolio, there's more to just, do I buy or rent? There is a deeper strategy to be thought about from that perspective. Do you agree with that, Billy, or any other points you'd raise with that?
Well, I think the main thing is it's different for everyone.
Yeah,
I do think it's like in Australia, it generally doesn't give you a good outcome if you never buy a property,
agree.
especially for retirement outcomes for people who don't own their home generally are not as good.
Agree.
So I think if you are renting, you don't have to buy a house and go live in it. There are other strategies, but generally speaking, you do want to try and acquire at least one property as part of your long-term strategy. But there's different ways to do it.
Yeah, I agree. I always
You
tell
don't have to follow
clients,
the path that everyone buy the first home, live there, wait so you can buy a bigger one. You don't have to follow that path. But it's a good move to at least try and acquire one property, I think.
Yeah, and I think I always tell clients the sooner you can get onto the property ladder, the better. But it can be a little bit of a trap, that property ownership situation, because buying the home and then you're just living in it, it's virtually just a shelter. It doesn't actually put any income in your pocket whatsoever. So if you have desires around financial freedom and not working through to getting an age pension or age 60 when you can access super, well, having a good family home actually won't help you there unless you're going to sell that at some point in time. That's the only way you're going to be able to then, release some of that gain they might have out of that property. So that, I think with it, like you said, it's really going to vary on situation. And, rent vesting could also be you rent and maybe you're investing super hard in your business and you want to live in a one bedroom, something super low cost. So your cost of living is really low there, but then you're going so hard in other aspects of your life and scaling up a business. So I always just challenge people to think about rent vesting in a different way, not just your standard buy and rent in a location. I think there is a lot more to it, and what suits your situation will ultimately depend upon where you're at and what you're trying to do. But what if we move on, Billy, to interest rates? That's a
very
hot topic. Interest rates are down. How did you take that news? I was pretty stoked to see that.
It's good to see that we've hopefully passed a peak and we're going in the other direction. Absolutely. The most interesting comment I thought in the RBA statement, because usually there's not much in there, right? They don't want to give too much away. Yeah. But the one interesting comment in there was, I think they believe the natural setting of where interest rates should be in Australia is quite a bit lower than where it is now.
Mm.
So I think they do want to have a number of cuts before we settle at hopefully hopefully it's a bit more stable in the future. So I do think they want to do more cuts, but they can't do it yet just because of the way the economy is and the data. So good news, going in the right direction, but we'll have to be patient.
And we had our investment committee review yesterday. So what did we get to with that? Like I think there was talks of probably maybe another 2 cuts is where we kind of left it with the investment committee. Is that where we were at?
Yeah, the general view is at least 2 cuts this year.
Yeah.
But they're not going to rush into it.
No, so don't get your hopes up. Don't bank on it. And I think if you're banking on interest rates falling or the movement of interest rates to, sustain your lifestyle, that's probably not a good move. You probably don't want to be at the mercy of the interest rate market and having to wait for a cut to survive or keep that property. That's never a good thing. And it's never a good thing to be in that situation if you're forced to sell a property because you can't make repayments on it. So that's why with all clients that we're working with, I always look at, making those figures look conservative and have a 2% buffer differential. So like, what if interest rates went up another 2%? Could you still afford your repayments? The banks normally look at that stuff with you anyway before they give you the loan so they can ensure you're going to pay it back. But those are things to actually consider and making sure you do have a buffer in place there. But the part I was going to mention is around interest rates falling. Naturally, that does have an effect on people's borrowing power, which is where it can start to get a little bit interesting, because that's where people naturally think if interest rates are falling, property prices are going to go up because more people are more optimistic and getting out there and spending. But interest rates haven't fallen that much. But naturally, as interest rates fall, the borrowing power of everyone is going back up. So that can put, I suppose, a little bit of a tailwind behind it. But it's not, we only dropped 0.25%. The cash rate.
It's not good if rates drop really fast.
Yeah.
It either means there's a major issue in the economy or high unemployment or something bad is happening.
Yeah.
Or if they just cut rates because we all want lower interest rates, it means the property market's going to be hotter and it's going to be harder to buy a property and prices are going to go up too quickly. So we don't want drastic cuts. We just want a natural easing, I think, over time would be the best outcome.
Yeah, I agree. I agree to that, Billy. I think everyone got too used to those 2% interest rates on a home loan. I miss those days, but
That wasn't
realistic.
reality. That wasn't reality. Yeah, we've come across a couple of clients who really went and maxed out their borrowing at 2% to buy a house, and it's not good. Yeah, and they're hanging on rate cuts now, but like as we've discussed, they're unlikely to come down anywhere near those levels again.
Yeah.
We don't want them to anyway.
We're taking a real measured view here on the old winners playbook, aren't we? We're taking a very sensible approach with it. So, no, that's good. That's good to hear. What about if before we get to closing out, Billy, talking about some of the smarter ways to save money on home ownership costs? I was thinking a bit maybe about some of those grants that might be relevant and stamp duty exemptions, which does vary between state, of course. So there's no way of saying what they're all going to be in all states are not the same. What are your thoughts around some of that, Billy, for people approaching buying, first homes or buying property or transacting a property? Because stamp duty is one of the biggest wastes of money, in my opinion. That absolutely hurts when you have to pay stamp duty on properties. You can avoid that sometimes on your principal residence if it's a first home, but stamp duty can be a nasty one.
Yeah, so saving on stamp duty, it's different in each state, but like if you're in Victoria, for example, there's no stamp duty if you spend less than 600,000, and there's concessions all the way up to 750. So it depends what budget range you're in. Like if you're lucky enough to be buying your first home for $1 million plus, don't worry about the first home buyer stuff. Yeah, they're not going to help you. But if you're down in that range, then it's absolutely worth considering. But I think the main thing is not spending all of your cash on that deposit, which we mentioned earlier. Like you need to keep your powder dry. Like you need a bit of extra cash sitting there for those extra costs that might come up. And there's a few ways to do that. Like how there's like LMI exemptions for different occupation categories.
Yep.
So for some people, they can get into a house with a lesser deposit and not pay lender's mortgage insurance. So you can look at, not putting down a 20% deposit, putting down a 10% deposit.
Yep.
Those sorts of measures, I think, are the main ones. The other strategy that's worth mentioning is once you run your numbers and you figure out roughly what those mortgage repayments are going to be, try and build that into your budget before you buy the house.
Sure.
Right. So you pay your rent, but then you're also saving, a couple of $1,000 a month, whatever it is. Like, build that into your budget before you've actually got that home loan, so it's not as much of a shock once you go and make the move.
Yep. Yeah, no, I agree. I think it's great, Billy. I used on that first property. I was lucky enough to take advantage of the no stamp duty, so I got no stamp duty on that property, and also was lucky enough to get the first homeowners grant for when we purchased that property. I think it was like $560,000 that we purchased for back then. It's fortunate it's worth a lot more money than that now, but I think that saved me about 40 grand. So if you can take advantage of those benefits, but of course it does get quite restrictive now on where you're going to be living, because if I talk to the southeast of Melbourne, like where are you going to buy for $600,000 close to CBD? Like it's not realistic unless you're going to buy a unit, which we've already talked about why sometimes units aren't great ideas. So that usually means you're going to be pushing out into the suburbs, really. You're pushing right out into the fringes from that perspective, which some people don't want to do. So some people don't actually want to do that. And that's where sometimes that rent vesting strategy might be better, because you might want to live closer into to the CBD, but you still want to get on the property ladder. Maybe you just buy an investment property somewhere, and that could be anywhere in Australia, not necessarily the state you live in. And I think that's maybe a point worthy of noting. Like I think a lot of people do have this weird sort of bias of thinking that they know a lot about property and like locations, and you typically buy where you grew up. Yeah, like everyone usually does that. You buy where you grew up, but that's okay if that's just where you want to live forever, but it doesn't mean that's going to be the best investment opportunity for you into the future. And that's where, if you consider that rent vesting strategy, well, all of Australia basically opens up, because you can rent just where you want to live, near CBD in your state or whatever it may be. Don't have to worry about buying that property, and then you could buy anywhere in Australia as an investment property, and you have a property manager that looks after it for you. You don't really have to do much. I've got properties and I don't do anything basically other than respond to the property manager. So I think if you open your eyes up and you just look at those alternative scenarios, I think there's a lot more to it.
Yeah, spot on. Don't pay too much attention to colleagues or relatives or other people telling you what to do. And don't have too much of a fixed mindset around it. Like I have to buy a house, go live in it, so I get exemptions, or rent vesting is a great strategy for some people. So.
Yeah, no, I agree. And the only final point I was going to mention is around just when you're buying property as well, do just put a bit of consideration around the structure you're owning through. So are you going to buy in your individual names, which is typically what you do if you buy a home you're going to live in, like a principal residence, typically happens in your own individual name. But if it's going to be other structures, you can buy property through trusts or a company, through a self-managed super fund. That's a lot of the work that we do with our clients, because the last thing you want to do is get that asset, not just property, and you have it in the wrong ownership structure from the beginning, and then that hurts you tax-wise down the line if you want to sell that property, or that it's positively geared at some point in time in future. And also worthy of noting, even for business owners, it's like one of the things I see so commonly is business owners owning property, their family home, having that in their own individual name or with their partner, and them not knowing that quite possibly if something goes wrong with their business and they're the director, they're liable for it. If something goes wrong with the business, potentially people could come after that family home and get access to it, or take it, or force you to sell it so they can get their money back, or whatever may have happened. So it's just a point I wanted to mention, just for business owners, always worthy of noting that ownership is very, very critical from an asset protection point of view. And personally, before I got involved in the business, did transfer our family home out of my name, which doesn't cost much money. I think it was like $1,000 to a conveyancer. There's no stamp duty on that between spouse on a principal residence, depending upon state. Of course, don't just do this because I've said it. Go get your own advice and reach out to a professional, come through and have a chat with us. But there's a lot more out there to consider, I think, before you just go out there and spend $500,000 or $1 million on property. Would you agree, Billy?
100%. Last tip I've got there is you need a good mortgage broker. I still see people going directly to the bank, or
so true.
I've always been with CBA. I'll just call CBA. They help me. No, there's dozens of lenders out there. So they're not going to be loyal to you. So don't be loyal to them. Just find the best deal. And a really good mortgage broker is the best person to speak to about that.
I think that's a great way to close out, Billy. Well, guys, we're going to wrap it up there. And as I always say, as long as you're getting value out of the podcast, please leave us 5 stars on Spotify and Apple. Subscribe to our newsletter. Feel free to jump on the website and take a look at any of the advisors if you do want to have a chat about your personal situation, or as Billy was actually saying there, maybe if you're buying your first home, you might even want some help running some numbers for the first time. And we actually do have a mortgage broking arm as a part of our business. Eddie and Carlo looking after that side of things. Link Wealth Finance, you can actually check their stuff out. They actually run their own podcast as well, talking all things property and buying your first home and costs, mortgage, interest rates, etc. So worthy of taking a look. But we'll wrap it up there. Billy, appreciate your time, mate, and I look forward to seeing you on the next one.
Yeah, cheers.